y'all, it's CJ here. Welcome back to my channel. And today I'll be doing a video on just giving my thoughts on some of the stocks in my watch list on the Fidelity app. So I'm gonna go down the list of some of these stocks and I'm gonna give you like my opinion as far as if I'm invested and if I'm looking to invest, if I think it's at a good deal or if I'm not interested in it. So I'm not gonna do all of these, but I'm gonna do some of them. So I'm gonna start with Celsius. So Celsius Holdings, it's at $54.60. It's a lot of analyst sell ratings on it. Like it's like, what is that? 5 sell ratings and 3 neutral perform ratings, which analyst ratings don't mean too much to me. I mean, it does affect the price a lot of times, but to me personally, the analyst ratings don't matter too much. And here's just some news about Celsius recently. As you see, on November 30th, Celsius to participate at the Morgan Stanley Virtual Global Consumer. A little bit older news. And this tells you about Celsius. Celsius Holdings develops, markets, distributes, and sells functional calorie-burning fitness beverages in the United States and internationally. The company offers its beverages in various flavors, including carbonated orange, wild berry, cola, grape, kiwi, guava, and watermelon, and non-carbonated green tea, raspberry, acai, green tea, peach, mango. It tells you all the flavors. Okay, it also provides Celsius Heat, a dietary supplement in carbonated flavors such as an apple jack, orange side, Inferno punch, and then it gives you all the flavors for that. And but as you can see, the total revenue as of, it looks like September 30th of 2021 was 245.68 million. It's in the food and beverage industry, of course, or sector. The PE on this is extremely high at 496.36. That's super high. Like, I was invested in Celsius at one point in time back when it was under $20 to the 20ish range, but I had sold out, and I was thinking of getting back in. This is very early in my investing day, even though I haven't been investing as long as some. I've been investing since February of 2020, but this was still early within that year, and I was more in the trading mentality. So I was getting out and I was trying to get back in, but the price of Celsius stock skyrocketed so much that I wasn't willing to pay that much of a premium for this. So I do believe it's very overvalued. As you can see, the price to book is 26.87, and the profit margin is only 2.89%. For paying that premium, they would have to have much higher profit margins. I mean, it's nice that you're profitable, and I do like to invest in profitable companies, but it's too much of a premium for me, for my taste. And as you can see, they don't have much debt, very little debt. And as you can see, their earnings for each quarter, for the most part, they've been positive. They've been making a little bit of money, except for one quarter back in 2019, which they was in their very early stages. So it's expected. But yeah, I'm not currently invested in Celsius right now. I used to be. I think it's overvalued. I mean, if it comes, maybe if it comes back down into like the 30ish range or 20ish range, I might consider investing again, like starting another position in it. But right now, it's just too overvalued. Like I like their products. Like I'm into exercise, fitness, and all of that. So I use a variety of their products. Like my favorite beverage that they serve is like the peach mango. That's one of my favorites. Like it's amazing. If you haven't tried it, I would urge you to go and try it. They have carbonated and they have non-carbonated, depending on which one you prefer. Some people say the carbonated burns their throat. I mean, I mean, either is not a problem for me. I like a lot of their different drinks. I'm not a big fan of cola, beverage taste, but that's just me. They serve great products and it's a great company. So I'm gonna keep an eye on it. As well as, and you have in phase energy, and it was down 4.19% on this is as of Friday. It was 145.13. Phase has been interesting as well for me. I used to be invested into this early, like early on. As you can see, some of the news, S&P 500 starts 2022 with 1.9 weekly loss, led by real estate technology. So they're talking about the S&P 500 as a whole, and phase is included into it. Piper Sandler adjusts price target on phase to 227 from 207. See, the analysts they go up and down on the price target so often, and it's not. Sometimes, a lot of times, it's for their own benefit. I think they may be trying to tamper with the price sometimes and get it to go down for them, so they could buy in at a cheaper price and then raise it afterwards. But that's not all the time. That's sometimes. Not everybody does that. But Enphase Energy battery storage installations increase in Washington. So Enphase is another great company that's already profitable and they're receiving a good amount of revenue. Back in 2021, they had a big fluctuation in price to the upside. They were over $200, I think. Okay, Enphase together with its subsidiaries designs, develops, manufactures, and sells home energy solutions for the solar photovoltaic industry in the United States. And internally, the company offers semi-conductor-based microinverters, which converts energy at the individual solar module level and combines with its proprietary networking and software technology to provide energy monitoring. Enphase Energy was incorporated in 2006. It's headquartered in Fremont, California. So that's a little bit about Enphase. They're into the solar business, so this is is a good stock in terms of that. They have the microinverter says the microinverter systems, you know, systems that you could buy and put on your house and different businesses. Hook it up to the electric system. But it's a great company and has good leadership in industry, semiconductors and semiconductor equipment, information technology. The P ratio is 126.20. I mean, that's still pretty high. Price to book 31.65. Profit margin 6.20%. It has a decent amount of debt on its balance sheet. 61.69% compared to its cash levels. So it's still, I think it's more fairly valued than Celsius, definitely, but it's still a little overvalued. But it's coming down in price, and it's starting to get attractive once again. As you can see, they've been killing it on their earnings. They've been beating earnings estimates, as well as they've been profitable. They've been more and more profitable just about each quarter. You know, they was affected by the market crash of 2020 and just the time period of the pandemic and everything, of the shutdown. I'm sure sales were pretty low. Multiple industries were affected back in Q2 of 2020, so that's very understandable. And even in Q3, but as you see, they got back in earnings and continues to raise them quarter over quarter, year over year. You know, total revenue as of September 30th of 2021 was 1.23 billion. It's a nice company. Earnings per share $1.14. Let's look at the chart. As you can see, it came down a lot from November of 2021 to now. It's came down so much. It was at, looks like $267. As it was saying before, it was over 200. Down to 145. That's a big drop. And it's becoming more and more attractive. Like, I think this is a good time to start a position in phase. I'm personally not currently looking to start a position just yet, but I am interested in it, and I will continue to keep an eye on it. Of course, you have Tesla. I am invested in Tesla through my Roth IRA, through the Vanguard ETF, Boo. So it's currently at $1,026.96. It was down 3.5% on Friday as a closing. And it had came down a little bit. Well, first it shot up to, it was a crazy shoot up. It was $1,229. Then it went down and then shot back up a little bit. Now Tesla is always looking for the quote unquote right price. It's always looking for that right balance. And Tesla is just so volatile. Like, you never know what price it's going to end up at. I mean, the sky's the limit with Tesla. And they're delivering on earnings. Earnings per share were $3.08. As you can see, it has 3 buy ratings, 4 neutral ratings, and 1 sell rating from the analysts. It's overvalued $610.35 is their estimate for what it's worth. And it kind of shows you, this is why I like Fidelity. They show you all of these different aspects of investing that helps. 97.7% they're in the automotive industry, 0.5% they're in the service and other, 0.5% energy generation and storage, 1.3% net cash balance. So as the news, it talks about the Wall Street ahead hawkish. Fed gives value stocks a second wind. They're talking about it as a whole, but here's some specific. The Tesla, it raises its full self-driving software price to $12,000 in U.S. Musk says. He made a tweet. And just as always, it tells you a little bit about the company profile. Tesla designs, develops, manufactures, leases, and sells electric vehicles and energy generation and storage systems in the United States, China, and international through direct and used vehicle sales, a network of Tesla superchargers, and in-app upgrades. Okay. Everybody knows what Tesla is and what it's about. So I'm not going to read all of that. But the company is putting up numbers. They had total revenue as of September 30th. It was $46.85 billion. They have 1 billion shares outstanding. They have institutional ownership of 40.96%. The PE is 332.35. I mean, Tesla is always overvalued. It's all about what investors think the company is worth. And Tesla is just one of those companies that's pretty much always going to be overvalued. They're like any other company. They're unlike any other company out there. So, I guess their valuation can just be justified by that. And they have Elon Musk, and he's a genius. He's constantly innovator, and it's a founder-led company, which means you're gonna get more innovation. It's still in its baby stages. They're still rapidly expanding. Not a lot of debt. The debt to cash is 26.77%. Profit margins 11.76%. Price to book 41.36. As you can see, they've been doing well on earnings. They only missed one quarter, which was quarter 4 of 2020. But as you can see, they were profitable all the way from Q4 of 2019 to now. So they're making money. So yeah, I'm invested in it through my VOO ETF and my Roth IRA. It's self-explanatory. It's Tesla. One of my dream cars. I know a lot of young people, their dream cars is Tesla. Nowadays, as the world is trying to go more electric. I wouldn't say a lot, but there's quite a few young people out there wants a Tesla for their dream car. They're pretty cool. some people don't think it's the most attractive vehicle, but I personally like it. I mean, they say once you go EV, you don't go back. I've never driven an EV car before, but I plan to in the future. And Tesla seems like a very reliable brand. Like you see more and more around the cities. So over the recent years, they become more and more popular as the world tries to transition to more green energy friendly vehicles. So it's tons of growth. It's a growth company. NVIDIA, I am also invested into it through my Roth IRA. It was down 3.3% on Friday as a closing at $272.47. And the good thing about the NVIDIA is it pays a very, very small dividend of 4 cents per quarter for every share that you own. So, not many. Normally, tech companies like NVIDIA, Apple, Microsoft, tech companies like that, either they pay no dividend or you're lucky if you get a dividend. And if you do, it'll be a small dividend because they're mostly focused on growth and innovation and trying to keep up and outdo competition because it's a very competitive field. So they're putting their money into other things opposed to paying their shareholders. That's not like their main focus. As you can see, the dividend yield is 0.06%. The earnings per share is $3.24. PE ratio is 86.91. That's not bad compared to the other ones. That's not as bad. I mean, it's still a little overvalued, but that's not too bad, I guess. It was at 323 on November 29th. Now it's at 272. That's a decent drop. On October, it was at $205.04. That's interesting. Okay. So you got 3 buy ratings, 1 outperform rating, 3 neutral ratings, and 1 underperform rating. Oh, so they're saying it's undervalued. That's interesting. 332.26%. Yeah, they're saying it's quite a bit undervalued. So 55.9% is in GPUs, 43.1% is Tegra processors, and 1% in net cash balance. Let's go further down. NVIDIA Corporation operates as a visual computing company worldwide, operates in 2 segments, graphics and compute, and networking. The graphics segment offers GeForce GPUs for gaming and PCs, the GeForce Now game streaming service, and the related infrastructure and solutions for game platforms, Quadro, NVIDIA RTX, GPUs for enterprise design, grid software for cloud-based. NVIDIA has a partnership with Google Cloud to create AI on 5G Lab. NVIDIA Corporation was founded in 1993 and is headquartered in Santa Clara, California. NVIDIA is an awesome company. So it has total revenue of $21.9 billion. Semiconductor and semiconductor equipment industry, information technology. It has a lot of shares outstanding. at 2.5 billion shares outstanding. A lot of institutions own a decent amount of this company, 63.70%. That's the highest I've seen in a long time. This is kind of like a go-to company, it seems like, for the big institutions. Like a lot of these big companies are like go-tos. The bigger companies like Nvidia's, Microsoft's, Amazon's, Apple's, Netflix, Square's, all of those bigger companies that kind of hold up the S&P 500 and the Nasdaq. Because when they fall, the whole market kind of tanks. So the P/E ratio is 97.14%. A little high in my opinion. Price to book 37.55. Profit margin 36.47. That's a good profit margin. They're very profitable. Debt 37.44%. That's debt to cash. They have more cash than they do have debt. That's always a good sign. As you can see, they've been profitable, and they've been also beating analyst expectations. So that's awesome. So Nvidia has always been a great company to me. I mean, I think this is a good opportunity to enter it. This is not financial advice. This is just my opinion. I do think the price came down quite a bit. It was in the 300s a few months ago. So, yeah, if you want a piece of it, now would be the time to start looking at, do your research and start looking at getting into it. And it's going to continue to generate revenue in the future. And it's not going anywhere. NVIDIA is not going anywhere. Like, I've used their tablets and different things in the past. They have great processing chips, and it's a smooth experience. So I like that, and it's good leadership. I like that about them. And then Grow Generation. This is one of the stocks I was invested in, and I'm planning to invest in again. Like, it's been down like so much, like crazy. Let me show you something. Back on February 9th of 2021, this stock was at like $63.80, and it's trading at $11 a day, or as of closing on Friday. That's crazy. It's in the cannabis industry, and as you can see, all of them have it as a sell rating, 4 of them, and then 2 of them have it as a neutral. They recently just bought the assets of Mobile Media for $9.4 million. So that was quite a big cash stump for them, but they got plenty of cash, and they have little to no debt, so they will be all right. But the stock reacted negatively to that, which I didn't even think was possible because it was already down so much before the acquisition, or before they bought the assets. The COO, retired. His name was Tony Sullivan, which I really only care about the CEO, and that the management team as a whole is good. I mean, that doesn't change my mind just because the COO retired. I mean, they still got a good leadership team. As you can see, Grow Generation, through its subsidiaries, owns and operates retail hydroponic and organic gardening stores in the United States, and engages in the marketing and distribution of horticultural, organics, and lighting and hydroponic products, including lighting fixtures, nutrient seeds and growing media systems, trays, fans, filters, humidifiers, dehumidifiers, timers, instruments. I mean, the list goes on. Especially retail, consumer discretionary. They had total revenue of 332.84 million. This is the summer of 2021. So they got plenty of revenue, and they continue to get more and more revenue over quarter over quarter. They have 59 million shares outstanding and very little debt, 8%. Profit margins, they are a profitable company, 5.33%. Price to book, 2.18. That's great. P/E ratio of 38.48. I mean, you can't beat that. You can't beat that. It's at a great deal. They have missed analyst expectations, but they're still a very early company in its early stages. It's not a big deal. They've been profitable all quarters except for Q1 of 2020. And I think Q1 is usually their weaker quarters, if I'm not mistaken. It's like their weakest quarter. So that has to be taken into consideration. They had 83.33% earnings per share growth. That's nuts. And I don't pay too much attention to the technical analysis as far as on here. But it's a great company. If you want a little bit of exposure to the cannabis industry and you want something relatively, you don't know what company is going to win as far as in the cannabis industry, but this is a great bet on the mob. So this is a good company that wins. Whenever they all win, this company wins as well because it acts as a picks and shovels play of the industry. And I believe it's the #1 hydroponics growth store in the United States. So I hope y'all have a blessed rest of y'all day. Thanks for tuning in. Remember to like, comment, subscribe if you enjoyed this. And I love y'all, and peace.